Bill O'Neill says buy exactly at the pivot point. This takes some skill, some practice to be able to do that, but it's very, very important to be able to do that. By buying early, I have a better chance of not getting shaken out if the stock corrects a little bit. If this position starts to fail, I have a better chance of recognizing that it's failing and being able to sell it before it goes down 7%. I would have bought it probably on the high of this day right here, because I tend to put my orders in a little tiny bit before, and this would have filled that day, but that'd be fine. So we'd buy it that day. Here's the cup base. It has good parameters. There might be a couple of add-ons. At the profit goal, it's sold. There's absolutely no reason to hold this stock past the profit goal. Bill O'Neill has only one rule in his book for holding a stock past the profit goal, the certainty exception. This stock doesn't even come close to that. I don't allow myself to change my sell rules or any of my rules during the week when the market's open. So I can't just, jot out a new rule when I feel like it. I have to wait till the market's closed on the weekend to change my rules. This would have been bought right here around 173.50, the new high right here. And it started to go and then it failed. This day right here is very clearly a breakout failure and plunged below the 50-day line on high volume. That's when it needs to be sold. So Convalt, I ended up with about a 2% loss. I know from studying long-term charts, the market's going up about 75% of the time, so I should be optimistic. When the market is going down, I have sell rules to protect me. So if I misread the market and I think it's going up and it's really going down, I'm not going to get hurt if I follow my sell rules, if I check every day, because my sell rules are going to trigger me out and save me. If the market's going up, however, and I'm not invested, there's no rules to protect me. I will have losses that aren't accounted for in the books, but that they're going to be losses nonetheless.
All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion conference, Lee Tanner. Lee is a former chemical engineer and U.S. Navy submarine officer, and he's been a CANSLIM investor since 1988 and is the co-organizer of the Petaluma IBD Meetup. Lee, first of all, thanks so much for being here and looking forward to diving into your presentation.
It's a pleasure to be here for the TraderLion conference 2025, and I'm going to talk about a growth stock investing method, the Bill O'Neill growth stock investing method. I'm going to show some of the rules that I use and some recent example stocks. First of all, this presentation is for educational purposes only. I'm not recommending stocks and securities to buy or sell. All investing has substantial risks of big losses, and CANSLIM is the registered trademark of Investors Business Daily, or William O'Neill and Company. I'm not sure exactly which now. Anyway, the Bill O'Neill growth stock investing system, which is sometimes called CANSLIM, is really pretty straightforward. He tells us to look for stocks that have these top fundamental and technical characteristics, which he describes as current earnings, annual earnings, something new, supply and demand, leadership qualities, institutional sponsorship, and to do this while the market's favorable. And then to study the charts and to pick out stocks that have these properties that are completing standard proper bases and that have a 30% prior uptrend that tells us institutions are already accumulating positions. And then study these charts carefully and determine what the pivot point is or the ideal buy point and buy the stock exactly at the ideal buy point. That's a word he uses, exactly there. And then we hold the stock. If it goes down 7 to 8%, we sell it without questions, and that's our capital protection sell rule. Otherwise, we hold it, and holding it is a key part of this system. We hold it. The objective is to hold it till it goes up to the profit goal, which is 20 to 25% from the standard base pivot point. This is something that gets overlooked when we read the book, this holding part. And some people, it'll get up here and it'll start to come down and they'll want to take profits. We hold it. This is not swing trading. Then when it gets up here, almost all the stocks that are bought this way get sold when they're up 25%. There's very few exceptions to that. And in his book, he has only one exception, which he calls the certainty exception. And that doesn't get applied very often. So that's the basic system. It's simple and it's rule-based. And since it's rule-based, it means that I can learn it and I can do it. It's like doing a recipe. A Draminier souffle is a fairly complicated thing to make correctly, but if I have a recipe, I could do it. And I may not get it right the first time, but I can eventually learn how to do it. That's what CANSLIM investing is like. I can do it. I can learn it and follow the rules. Now, some people ask, does this still work? Everybody knows about this. Bill O'Neill first started teaching this to the public in 1984 when he launched Investors Daily. And his first book came out in 1988. It's been updated several times, last time in 2009. So everybody knows about Bill O'Neill's growth stock investing system called CANSLIM. Well, it still works for sure. And the reason it does is chart patterns are based on psychology and the laws of supply and demand. And neither of these have changed. The same patterns work today as did decades ago. When we go back and study old charts and new charts, we can see that for ourselves. The other thing is earnings growth expectations are what attracts big money to come into stocks. Institutional investors want to put their money into stocks that they think are going to have high earnings growth, and those are the stocks we want to pick out. Now, Bill O'Neill teaches us, the individual investor, the easiest way to do that is to pick stocks that already have a recent history of current earnings and annual earnings, and something new that's driving that earnings growth. Now, everybody knows CANSLIM, but very few people actually practice it. There's many variations to it, and the markets are much larger than they were in 1985. They're hugely larger. There's more stocks, and there's more dollar volume. So CANSLIM still works just fine. And I'm going to be talking about the classic William O'Neill book version of CANSLIM that's taught in these books here. The first 4 books teach the CANSLIM system. This book by M.P. Smith talks about individual investors who have learned to do it. This is the best bang for the buck if you want to learn CANSLIM investing. Start out with these books. I suggest them in this order: 1, 2, 3, 4, etc. Also, the investors.com website, the Investors Business Daily paper, is tailored toward CANSLIM investing. And the website, even though they do other things now like swing trading and leaderboard, is primarily CANSLIM oriented, and so it's a very useful website. They have a good section on learning it there. You can go to that as well. Now, I like to consider the Bill O'Neill CANSLIM business as 6 basic activities. I break it up into sort of 6 basic activities. The first activity is what we're doing today. By looking at this video, we're studying and learning, and when we study and learn, we want to develop written rules. The next activity is making a watch list or deciding which stocks to buy. This is the most difficult activity, but it's the second thing we need to learn to do. And it really is the hardest part as far as I'm concerned. Then buying just right. This takes some effort to do it right. It's not just a piece of cake, but it's not that difficult. Managing a portfolio is fairly straightforward. And selling just right. A lot of people worry about this. They think selling just right is hard. It's not. It's actually one of the easiest aspects because it's very strictly rule-based. At least the way I do it is. I want objective sell rules so I know when to sell. Then we review periodically to see what we're doing right and wrong, and we learn from the experience, and we do it over and over and over. It's like the recipe. The first time we do the recipe, it may not be very good, but the 5th time we do it, it's pretty good. The 10th time, it's probably perfect. So now we don't learn CANSLIM investing quite that fast, but we can get to it pretty quickly. Here's an example, a recent example. People asked, does this still work? This example shows it does. This is Netflix on April 1st this year. Netflix had all the characteristics that O'Neill tells us to find to pick a stock. It was after the earnings report. It was on the IBD 50 list. Any stock that's on the IBD 50 list has good enough CANSLIM properties for me. It was on the Big Cap 20. It was on the Growth 250. It was on the leaderboard. And a very strong prior uptrend. From here to there, it was a shallow base. The base was 23%, and the general market had corrected 27%. It had a very strong relative straight line because of that. 5 top mutual funds owned a position in this, and it just reported earnings. So this is a very good setup. The only flaw in this setup was This was a fifth stage base here. Pattern recognition said it undercut, but barely. This is a late stage base. But I only need, when I buy a stock, I'm only looking for it to make 25% advance. And this stock will probably make a 25% advance if this breakout works at all. So buy it right here. It's easy to buy right at the pivot point. The earnings report was on the Thursday. Friday was a holiday. Monday, it traded up to that. It could be bought there. If you missed it that day, you can get it early the next day. There were 2 add-on buys that might have been made, and it went to the profit goal, and that's when it would be sold. There was absolutely no reason to hold this stock past the profit goal, even though it later went higher. We sell it at the profit goal, and we made a 25% gain in 7 weeks, almost a 500% compounded annual growth rate. With the add-ons, it was a 20% overall gain and about $12,000 in 7 weeks. That's good work if you can get it. So that's the classic Bill O'Neill growth stock investing system, just to demonstrate it in that one stock. So the first activity we do is studying and learning, and whenever we're doing this, our work product here is written rules. That's the work product of this. The next activity is to make this watch list, and this is the most difficult part, but we can simplify it. Now, I look for stocks in specific places, and I try to make my work as easy as possible. I use the IBD screens that are investors.com. These are easy to use. The IBD 50 is my go-to screen, but then the sector leaders, IPO leaders, big cap 20, stock spotlight. This is the shortest screen and most selective. This favors stocks that are new issues. This favors higher cap stocks. This favors stocks that have a higher relative strength. The market surge list, growth 250 list, is designed to pick stocks with the characteristic of every stock in the database that was ever successful, to pick it out before it broke out. It's a combination of several screens. It's usually about 300 stocks. They don't change that much every week. If you go through all those, you're not going to miss anything. The stocks, ideas that people share with me, I look for there. And stocks that I keep track of, and I have custom screens. But the go-to list is the IBD 50. That's where I start. I never do a watch list without starting there. And that's only 50 stocks. And any week, there's only 2 or 3 of those that are in bases that are near a pivot point. Most are extended, or some will be deeper in a base. So it's not that difficult to do. When the market's correcting, this is when it's the best time to do this too, by the way. The next activity we need to do is to buy just right. Now this is, Bill O'Neill says, buy exactly at the pivot point. This takes some skill, some practice to be able to do that, but it's very, very important to be able to do that. So buying just right, exactly at the standard pivot point or before. I use Wallen, William O'Neill, and IBD taught early buy points. I use these a lot. I buy one full initial position at one price. Now it's okay to scale in, and I used to do that, where I'd buy the first tranche, maybe 50% of the position right after pivot point. Then I'd buy the 30%, maybe 2% above that, and maybe 4% above that. I'd buy the final 20%. I stopped doing that. I found out it didn't help me, so I just buy it. But it's okay to scale in if you want to. And I don't use any volume signature. I want the stock to have breakout volume, but I don't wait to see the volume to make the buy. This is kind of a departure from what you think Bill O'Neill is saying in his book, and in fact, it is a departure from what he says in his book. But he and his portfolio managers don't wait for volume either. So the key for me is to learn these early buy points and to use them. And they are pretty standard. This is a standard cup with handle. This is a trend line early buy point on a cup with handle. This is a handle high early buy point. And this is a This is the hardest one to find here. Picking it the low when volume dries up. That's very hard to use. I don't use it very often. Double bottoms have a similar situation. The standard, the trend line, and then this Shakeout +3. This is one of my favorites here. I'll talk about that more later. So as I said, I don't use a volume signature to make my buy. Price wholly is my trigger. And I want there to be a plus 50% breakout volume, but at the standard pivot point. But I always buy before I see it, because if I wait to see the volume, the price is always higher. If volume's flowing into there, price is moving up, and I'd rather get it right at the price, and then take a chance that it won't break out. So here's an example. This is Nvidia in January 4th, 2024. It has a very strong prior uptrend, and it has a base, and this is probably the best. This stock probably has the best CANSLIM characteristics of any stock at the time on the database. And it's got a flat base here, and pattern recognition said this was like 11% flat base. And here's the weekly chart. You can see the prior uptrend is really powerful, and lots of accumulation in here. This is a very desirable setup with a double bottom base. It had a Shakeout +3. You could have bought it there. But here's the base now, and there's 4 weeks tight right here. It's on the IBD 50 list right at the top. They identified this flat base here in the little note down here with that pivot point. And sure enough, a couple of days later, it did break out, and it had huge volume. Now, if I wait to see this volume, the stop price is already going to be 1 or 2% above this pivot point. I don't want to buy it up there. I want to buy it closer to that pivot point, and maybe even a little bit before. So I'm going to zoom in on this base. Here's the weekly chart I'm zooming in on. I got 4 weeks tight. So this is the 505 standard pivot point. Here's a 504 or so cup pivot point. So I can at least do that well. It's also a 4-week tight pivot point. So I can do at least this handle pivot point, 504.33, but I can draw a trend line on this handle from that high to that high and continue it on over, and I can find an ideal buy point on here. That's about 497. You got to kind of pick it off. I use another chart program that I can pick it off more exactly. Now I see here it's not just a flat base. It's a 7-week cup with handle, 11%, 6% handle, and it's tight in here. It's a really attractive setup. Now, the advantage of buying this early here is the -7% from this point is down here. It's below the 50-day line. If I buy the stock at this 505.48 pivot point, the -7% is right at the 50-day line. So by buying early, I have a better chance of not getting shaken out if the stock corrects a little bit. Also, by buying it early, if this position starts to fail, I have a better chance of recognizing that it's failing and being able to sell it before it goes down 7%. So, on Monday the 8th, instead of waiting for the stock to get all the way up here and seeing the volume, I buy it early, and I'm going to try to buy it at 497, and there's going to be no volume showing. Probably not even this much. It gapped up after, and ideally, I would buy this with a broker's buy stop with a limit. I would be ready to do it, over the weekend. I'd put that order in. So if I weren't looking right at my computer, I wouldn't miss the buy. So I put a broker buy stop at 497 with a limit of like 500. I'm really stingy on my limits. Bill O'Neill doesn't suggest doing this. He says use market orders, but he has a floor trader and he has people helping him. So I use these kind of orders and I'm stingy. And if I look up and I'm missing it, I can always cancel this order and put in a market order. So at the end of the day, this was a nice strong breakout. I see the volume, I'm like, I see the relative price range is going up and everything looks good. But if I had waited to see this, I would have bought this stock probably 2% above this higher pivot point. So as soon as I get the fill, I start looking for the volume. Now, if there isn't any volume, I can always sell the stock. If the breakout looks like it's petering out or not occurring, I can sell the stock. If the price is okay, I usually don't sell the stock, even if the volume's not there. Sometimes the volume will come in later. Sometimes it'll come in over a few days. And many times, the early buy points that I like to use don't get the signature breakout volume anyway. So, and I can look for the volume right away as soon as I get a fill. And the investors.com website, if you get a stock quote, they have a little thing here where they project what the end of the day volume will be. Now, on this day for Nvidia, whatever time of day I did this, this was near the end of the day. See, I did. They tell you the update time. They were projecting the volume would be below average that day by 32%. So I can go there. I used to put a Excel spreadsheet and I could figure it out myself, but they have it there for me now. Another recent example, Amphenol broke out on May 1st. Now, Amphenol had a double bottom set up here, and I could have done that, but I wasn't looking at it then because it wasn't on the IBD 50. By this time, it's on the IBD 50 at number 47, big cap 20, growth 250, second stage, 6 top funds have a stake in it. What's the new factor for Amphenol? Well, these data centers are being built out. They're building these data centers, and Amphenol makes the connectors that go into the connections that connect all this stuff together, all the blade servers and stuff like that. It's after their earnings report, and it's after the follow-through day. On the daily chart, there's a standard double bottom pivot point. Could have bought it there after the earnings report if I'd been looking at it, but I wasn't. So here it is, the standard cup, the follow-through day, the earnings report, and now it's up here at the standard cup pivot point. And if I had been, the relative strength line is making a new high, I would have bought it properly on the high of this day, right here, because I tend to put my orders in a little tiny bit before, and this would have filled that day, but that'd be fine. So we'd buy it that day. Here's the cup base. It has good parameters. There might be a couple of add-ons. At the profit goal, it's sold. There's absolutely no reason to hold this stock past the profit goal. Bill O'Neill has only one rule in his book for holding a stock past the profit goal, the certainty exception. This stock doesn't even come close to that. In workshops and stuff, he discusses some other rules, but that's the main one. This stock gained 25% in 9 weeks, 260% annualized. A $20,000 position would have gained $5,000 in 9 weeks, not including the add-ons. You have to do the math to see you'd earn more with those. So the next activity, so that gives a couple of examples of buying just right. The next activity is portfolio management. This is pretty simple, but it takes some thought. First of all, I need to decide how much money I want to invest in growth stocks. I don't necessarily want to invest all my 401k or anything, all my money in growth stocks. I need to pick out how much I want to invest in growth stocks. And usually I'm going to have a portfolio of 5, 6, or 7 stocks in the growth stocks, depending on how much money I have. So if I have $100,000 I'm going to put in growth stocks, I'm probably going to have 5 stocks. If I have $500,000, I'm probably going to have 6. If I have $1 million or more, I'm probably going to have 7. Bill O'Neill talks about this precisely in his book. And he says limit it to 6, maybe 8 at the most. Because you don't want to have too many stocks. You have trouble keeping track of them. It simplifies the management. And when you have one of these stocks that's really a barn burner, that goes up 200, 300, 400%, you don't want to start out with a 2% or 3% or even 5% position. You want to start out with a 15 or so percent position, so it has a meaningful contribution to your financial welfare. I buy equal sizes of these because I never know ahead of time which one is going to be the best, and it simplifies management. I make add-on buys to the positions that are successful. That's part of portfolio management, and I have a list of the add-on buy points. I use margin if it's a margin account, and I need to decide how much margin I want to use. If you're new, don't use any. If you're and gradually get experience, you can use more. Of course, if in a retirement account, you can't use margin at all. That's no problem. Then I check daily to see if the stocks I own are getting near an add-on buy point, and I check daily to see if the stocks I own might be getting near a sell point. Portfolio risk management. If I size my portfolio for 5, 6, or 7 stocks, the position sizes are going to be 20, 17, and 14% approximately. If I have a 7 stock, and then I have a capital protection sell rule of minus 7%. If I have a 7 stock portfolio with equal size and a 7% capital protection sell rule, my portfolio risk is 1%. Now, that's what Van Thorp suggested using. Van Thorp. He suggested a 1% portfolio management risk. 1% is not a magic number. It's a good safe number. If I have a 6-stock portfolio and a 7% capital protection, my portfolio risk is 1.2%. A 5-stock portfolio, my portfolio risk is 1.4. 1.4 is a very acceptable risk. The following buy points, there are 14 of them listed here. That's quite a lot. The first 3 of these are really like a bounce off the 50-day line, or pulling back to the 50-day line, or regaining the 50-day line. We can simplify this to 7, a 50-day bounce, a 3 or 4 week tight breakout, a new high after a gentle pullback like a handle on a cup. I use this one a lot. A short stroke, a continuation gap up, I use that quite a lot. The 12 or 15 days up, you got to watch your charts pretty carefully to get this one. You might skip it, and then only have 6. And a breakout from a new base. If I own a stock that breaks out from a new base, I can buy a whole new position at that point. So there's a few add-on buy rules that I use. Usually I buy 20% more shares, and there's 3 ways to do that. The most cautious way is to buy 20% of the dollar value of the initial position. So if I had a $10,000 initial position, I would buy $2,000 more with each subsequent add-on, no matter how many add-ons I've made or how long I own the stock. Each add-on would be the same. That's the simplest way and the most cautious way. The next way is to make a 20% add-on of the number of shares that I had in the initial position. So if I had a 1,000 share initial position, I would buy 200 more shares each time that I made an add-on. And so now I only make add-ons if the stock price is going up. So by buying 200 shares, I'm going to be adding slightly more dollars each time, but not hugely more than this. The most optimistic way to make add-ons is to buy 20% of the current position just before the add-on. So if I start out with a 1,000 share initial position, and I make the first add-on, I'd buy 200 shares to add on. Well, now I'd own 1,200 shares. The next add-on I'd make, as the stock moved up more, would be 20% of the 1,200 shares. Now you can see that progresses pretty fast, and pretty soon I'm making big add-ons. This is the optimistic way to do it, and this is the way I do it. I have a rule. If the add-on price is within 6% of the last buy price, I do not make a full 20% add-on. I scale it back, or I skip the add-on altogether. I don't want to cluster my add-ons too close together in price and get a stock price that's too close to the current price. I don't want to get what they call top heavy. So if I look at the add-on and the add-on price is going to be only 3% above the last buy price, I will scale it back, either skip it altogether or scale it back to just a 10% add-on. If the stock price is within 5 to 10% of the profit goal, I don't make an add-on, because every time I make an add-on, the risk is 7% capital protection sell rule. Well, if I make an add-on within 5% of where I intend to sell the stock, it's going to be, I'm upside down in risk to reward ratio already. So I'd say 5 to 10%. I use 5%. That's pretty optimistic. You could say 10 or 12 or 14 even if you wanted to be more cautious. If there's a new base breakout, I can add a new initial position, and then I'm going to take a new profit goal based on that new base breakout. So we did portfolio management. Selling just right. A lot of people worry about this. It's actually very easy because I make my sell rules very objective and easy to follow. So there's 14 basic sell rules for the classic Bill O'Neill CANSLIM investing. You can find more. There's lots of other variations. IBD years ago had a list of 20. Bill O'Neill's book has a lot of discussion about sell rules. I've sort of boiled it down to these 14 basic rules. The blue dot ones are totally objective. They're very easy to follow. You could put in broker orders for those. Capital protection. If it goes down 7%, sell it. You put a broker stop in. Profit goal. When it's up 20%, sell it. You can put a broker sell limit order in. I don't use a sell stop for that. I use limit orders. Earnings reports, very specific numbers. Decline from the peak, again, a very specific number. You can put in a trailing stop with the broker. The red dot one here is more subjective. You need to train yourself to use this rule. And the good news is, if you don't use this rule, it doesn't matter. You can skip this rule because if the stock goes down enough, it's going to trigger the capital protection, which is totally objective. The scary gap down is mostly objective, but a little bit subjective. The same with the short-term profit extension, and the same with selecting some stocks to hold for longer-term gains. So to apply these, I just check on a daily basis to see if any of these rules might be triggered. Now, I can simplify these sell rules and get it down to 10. If I don't use these others, I can still do very profitable growth stock investing with this system. Very profitable. And I just check every day to make sure that a sell rule is not going to be triggered. And I check particularly over the weekends. I can spend more time. Now, what about the general market factor, the M factor in CANSLIM? I know from studying long-term charts, the market's going up about 75% of the time. So I should be optimistic. When the market is going down, I have sell rules to protect me. So if I misread the market and I think it's going up and it's really going down, I'm not going to get hurt if I follow my sell rules, if I check every day, because my sell rules are going to trigger me out and save me. If the market's going up, however, and I'm not invested, there's no rules to protect me. I will have losses that aren't accounted for in the books, but that they're going to be losses nonetheless. Now, let me explain this a little bit. I think it's pretty obvious, but let me explain it. My bias, therefore, is to be overinvested rather than underinvested. So let's look at the recent market correction. It came down about 15%, started to rally and then plunged, and it was very, very ugly in here. And plunged, it was down, as the NASDAQ was down 27% right here. Now, it'd be very easy with all the news and the hubbub and everything that was going on here to say, well, this market is really broken. And I just better be very cautious and stay out of it. this is wide and loose here. And the news was very negative, the world trade war and all that stuff, et cetera, et cetera. And now there's a Father's Day here, and I could even be pessimistic through that because it was a pretty anemic Father's Day. And I just remember the news was very negative on here. Well, now all of a sudden it's above the down-sloping 50-day line. Now, I expect this, it's only 2 legs down. It's going to be 3 legs down. And I just better not get in here. I better be careful. Well, next thing you know, it's up here, mid-May. I think, oh, man, geez, this thing's rallying. I'm not invested. Maybe only one stock or something. This is not good. Well, geez, this is too late. This is going to correct. I just know it's going to correct. So I think this is the worst possible situation for me, a growth stock investor, to get in, is where I'm sitting here uninvested and the market's rallying. And now I'm sitting on the picket fence. It's just terrible. So for me, it's much, much better to be optimistic down here, even though it looks horrible, and to try some positions. If they don't work, the sell rules get me out. If they do work, I'm invested as the market rallies. So and I've learned this the hard way over a long time. So that's what I do. So the way that works for Lee is this market plunges 15%, starts to rally, and then this was a Friday here. Thursday gaps down, or Friday gaps down, and then closes at the low of the day. The news was ultra negative here. And I just knew from experience that this market was probably going to have at least a short-term bounce, and I should try and find something to buy. And on Monday, the market plunged down here and started to rally back. And mid-morning on Monday, in fact, fairly early on Monday morning, Pacific time, I said, this is time to buy. So I turned my buy switch on. Now, I could have waited to the end of the day. This is a really nice accumulation day here. Now, the next day, the market had a distribution day, or a distribution day. And it looked pretty bad, but it didn't get to the low of the prior day. So my buy switch is still on, and I'm looking for stuff to buy. The next day is very, very powerful. Now, I attribute this to a lot of short covering, and there's options trading and all kinds of stuff goes on these days that causes this type of surge. But this was a positive day. So my buy switch is still on. And the next day, it plunges, it gaps down. But when I do the math, this is an accumulation day. It's a support day because it's a 40% true range. And so that's also a good day. My buy switch is still on. The next day is another accumulation day. Now I look at the weekly chart. This is a very strong accumulation week. This is the highest weekly volume in a few years. This is very strong. Now, this doesn't mean the market's going to necessarily rally, but it confirms to me that I'm glad my buy switch is on, and I'm glad that I probably already bought 1 or 2, maybe 3 positions. Now, what do I do when I'm wrong about the market? And I do what I just described, and it doesn't work. Well, it didn't work the first leg down on this correction. It went down 15%. It's well below the 200-day line. And there's a rally day right here. Even before that, I'm looking to turn my buy switch on. And so I did. And I picked out this stock here, Ascend Pharmaceutical, and I bought it here. And, well, we know the market didn't rally, so what happened? The market started to rally, and then it failed. It went a pretty steep correction, with this kind of gap down business here. Well, what happens to Lee? Well, I bought the stock here, and the breakout failed, and right here, I know the breakout failed. And I can see the market's going down, so I sell it here. I take about a 3% loss. Well, I take a 3% loss here, but I have to do that at this point to be willing to turn the buy switch on when it's down here. If I don't turn the buy switch on here, I'm not going to turn the buy switch on here, and I'm going to miss out on the opportunity. So I just need to be able to do that. Now, that's the way I work. You need to figure out how you want to work. So that's the market factor. Now, periodically in a year, we review what we do and learn from our experience and make improvements. And Bill O'Neill calls that post-analysis. I can't discuss that in this presentation. But suffice it to say, he says, put your winning trades in one bucket, your losing trades in another bucket. Then review the winning trades and see what you're doing right. Review the losing trades and see what you're doing wrong. And try to learn from the experience. And take what you've learned and improve your written rules. Now, one of my favorite early buy points is the Shakeout +3 buy point. Now, Bill O'Neill calls it a Shakeout plus 3-point situation. He describes this in the first 2 editions of How to Make Money in Stocks, not the 3rd and 4th, but it's in the advanced home study courses, and it's in the IBD Investor Corner articles. And Bill O'Neill originally took this from Jesse Livermore, and it's basically a double bottom setup. Got a prior uptrend, the first leg down, the double bottom, and then the second leg down undercuts the first leg. That's the shakeout. The Shakeout +3 buy point is when the stock comes $3 above the first low. So if this low was $100, the buy point's going to be $103. Now he says so I'm going to say if the first low is $40, the Shakeout +3 buy point is going to be $43. Now this $3 rule applies only for stocks between $30 and $60, and that's because that's what Jesse Livermore gave Bill, and that's what he used. Now IBD and Bill O'Neill have extended the applicability of this Shakeout +3 situation for stocks outside the $30 to $60 range, and they've done that by going back and studying their database. And for stocks over $60, I use +5%, and that's because $3 at 60 is 5%. And for stocks less than $30, I use +10%, because that's $3 at 30 is 10%. And Bill O'Neill in his examples, he sort of does a scaling like that, but he still uses equal dollar amounts. You can study his examples and figure out what works for you. So another recent example stock. We'll go back and we'll look at Netflix with a Shakeout +3 setup. We looked at it with the standard pivot point. Now, as I said, my buy switch goes on early. This stock had the first low here, came down and had a shakeout. That shakeout was on the Monday. Now, this is an interesting setup here because as the market plunged from a 15% correction to a 27% correction on the NASDAQ, this stock didn't go much lower. On the Friday, which was a horrible day, it closed near the low of the day, but only about equal to this low. And then on the Monday, it went lower, but then closed above that. So this relative strength is quite strong. And of course, we saw that before. So the Shakeout +3 on this is Shakeout +5%, which is this green line, which is 897.24. I could round it to 900 if I wanted, but I tend to just use that number. This has all the properties we looked at before. The earnings report's not due for a while, so I can buy it right here. I probably wouldn't buy it on this day, just because it's a little bit too wild, and it closed below that. But I could have bought it the next day. I had 3 more days to buy this right at that Shakeout +3 buy point. And the -7% line is down here. So that's a fairly safe, even though this market's swinging around wildly, this is a pretty good place to buy it. Now, it turns out the earnings report is due here after the market closed on this day. And per my earnings report rule, I do not have enough profit cushion to hold for the earnings report. So the stock needed to be sold by the close on that day. in the post-market trade on that day, that was the Thursday before Good Friday, the stock would have been bought back at about the same price. You could, in post-market trade, you could see that the earnings report was okay. The stock wasn't going to plunge 20% or something. You could buy that back right away and have about a break even there from selling it. And so I would manage this stock as if I bought it here and didn't do that sell and buyback here. The next Monday, after the long weekend, the stock rallied up to the standard pivot point, and relative strength is stronger than ever. Now, the stock continued on as it did before and goes up to the standard profit goal as it did before. There's no reason to hold it longer. You sell it at the standard profit goal, and this has a bigger gain. That's the advantage of these early buy points, is you get a bigger gain. I get a 39% gain in 9 weeks, 700% compound annual growth rate, and overall 26% gain with these add-ons. Get an extra add-on in there. So that's the advantage of these early buy points. And the Shakeout +3, I favor it. Here's another example. Robinhood broke out on April 10th. Now, this is before the follow-through day, but again, this was using the optimistic point of view. I'm saying my buy switch is on. I explain why. Here's the 10th in the market. That's a NASDAQ market. Let's see with Robinhood. Robinhood, like Netflix, it made a pretty big plunge here on the 15% part of this NASDAQ correction. It rallied some, and then as the NASDAQ comes down almost twice as much here, Robinhood doesn't. It comes down just a little bit more, and the relative strength is stronger. And this is a good setup here, but there's still a Shakeout +3. It was on the IBD 50 list as it went up here, and so it had good CANSLIM properties just by virtue of being on the 50 list. Had a very strong prior uptrend. There's accumulation in the prior uptrend. It has a good Shakeout +3 buy point right here. And there was a couple of days to make the buy right in here. So it was easy to make the buy right in here, and it never corrected much. Now we get over to here, and this is where the earnings report is due on Robinhood. However, unlike Netflix, because I bought it early here, I have tons of cushion, a 28% profit already. It doesn't look like on this chart, but the numbers are bigger than on the Netflix chart, the spacing here. So I have a 28% profit cushion. When this earnings report comes out, I don't have to sell the stock. I can just hold it. After the earnings report, it didn't do all that much. It went down a little bit after the earnings report, and then it surged here. Now, this is the type of surge going to the standard profit goal that meets the criteria for using the short-term profit extension rule. And so in this situation, I would apply the short-term profit extension, and that would be the 10-day line right here. And I'd end up holding this stock past the standard profit goal. It's one of the few methods of holding a stock past the standard profit goal. And this stock has kept on climbing. And I don't know where it is today. I forgot to look. But, this chart here is a couple of days old. This stock so far is up 147% in 12 weeks. And it has a compound annual growth rate of over nearly 5,000% right here. And I'm going to use this 10-day line as my trigger. I'm not going to let the gains I have in this thing get away from me. I have a friend who bought this stock down here, like this, in this area. And he didn't use the exact buy point I use. He used a different one. But he has this in a margin account. He has a big, huge, giant, whopping gain in it. He has a giant position in it. Another recent example, Rubrik, May 1st. It was noted in the write-up for the IBD 50. Recent new issue Rubrik is a double bottom base with a 76.11 entry point. So I look at that chart. Here's the mini chart. I read these mini charts right out of the book, right out of the newspaper, just like this. And I can see this stock is a top group, 11th out of 197. Now, it's a new issue, so it doesn't have the greatest EPS rating yet because it doesn't have much in the way of new earnings, but it has a good composite rating and a strong relative strength rating, and it's good enough to be on the IBD 50 list, so it's good enough, mostly good enough for me. It has a high volume, and it's a $70 stock, so it has high liquidity. That's good. It has a very strong prior uptrend, 180%, and I can see that right on the mini chart, 28 up to about 80, and so that's good. I can also see right on the mini chart, I can see strong accumulation. You got these accumulation weeks here, and then I have 5 straight up weeks right here going into this base. I have a couple of strong accumulation weeks in the base. And the note down here talks about the standard pivot point, but I can see there's a trend line on this, the early buy point trend line. The daily chart has a strong uptrend. It has all these properties here. Double bottom base, earnings report was here. Market follow through day is here. I buy this stock right here. Then I'll probably buy it on this day right near the high. And I probably used a market, a broker buy stop with a limit. I got right near the high that day. The buy point's there. The profit goal is right here. There's no reason for me to keep this stock past the profit goal. It triggered the certainty exception. That's what this flag is. They call it the power from the pivot flag. It was up 20%, 3 weeks or less. However, one of the key criteria for applying that rule is that the market's in a strong bull market. And I did not think mid-May that this market was in a strong bull market. I figured it was a bounce off a low, and I expected more correction. So I would not have applied the certainty exception. Here's one of the most attractive aspects of Rubrik is this very, very powerful uptrend out of the first stage base here. This undercut, so it was technically a first stage reset, but I really consider it more like second stage. Now, why not apply the certainty exception? I didn't consider this a strong bull market. Now, maybe I was wrong. The market has since gone into new high ground, and it may be a rally. This correction may be similar to 1998, where it was a V-shaped correction and the bull market continues. But at this time, I didn't figure it was. Now, what about Convalt? Convalt was mentioned in this note here. So I went for Rubik. Maybe I'd go for Convalt as well. It was on the IBD 50 list. It has decent properties, not as good as Rubik, but good enough. If it's on the 50 list, it's probably good enough. And this one was. It had a good prior uptrend. It has some accumulation in the base. Here's what the daily chart looked like. The market follow-through day was here. The earnings report is here. So I'd have to wait for the earnings report. And this was buyable anytime after the earnings report, anytime between here and here. Now, I didn't buy Convalt, but if I had, I might have bought it when it made a new high right here, or I might have bought it at the standard pivot point. Well, not everything works. Not everything on the 50 list, and certainly not everything that I buy. So this would have been bought right here around 173.50, the new high right here. And it started to go, and then it failed. This day right here is very clearly a breakout failure and plunged below the 50-day line on high volume. That's when it needs to be sold. So Convalt, I ended up with about a 2% loss. And I might have made an add-on buy here, so I would have had even a little bit more loss, maybe 3-4%. So the sell rules work. With Rubik, it was a 32% profit when I sold it at the profit goal. With Convalt, 2, maybe 4% loss when it placed below the 50-day line. Now that's how the Bill O'Neill growth stock investing system works. I make good money on the ones that work. and I cut the losses short on the ones that don't work. And in my actual work, probably about half the stocks I buy, maybe less than half, 40% work, and the rest don't work. And the average losses that I have on the ones that don't work is probably around break even, because some start to go up toward the profit goal and then they fail, and they don't have to go all the way down to -7% to be sold. So the William O'Neill growth stock investing system is like this. Pick stocks with tip-top CANSLIM fundamental properties that are completing full standard bases that have a 30% prior uptrend. Buy exactly at the pivot point or even early using sound early buy points and skilled chart reading. Apply good portfolio management practices. That means not too many stocks and to be concentrated and to monitor carefully what you own and to watch for sell rules and add-on buy rules. Sell per your written sell rules only. Never sell anything unless it triggers a written sell rule. And I don't allow myself to change my sell rules or any of my rules during the week when the market's open. So I can't just, jot out a new rule when I feel like it. I have to wait till the market's closed on the weekend to change my rules. That way, I really am rule-based. Then periodically review my trades and learn how to improve. Here's a big winner, AppLovin, August 8th, 2024. This was a variation on a Shakeout +3 situation. The stock had a really strong prior uptrend. During this time, it was on the IBD 50 list all during this. This is the kind of stock I'd be observing the prior uptrend and see it on the 50 list. And I'd be keeping an eye on it for when it formed a base. It formed a base here, and truth be known, I bought it here, and look at that, it didn't work. But I didn't get discouraged. I sold it here, actually. So, little loss. But this guy comes now and has a Shakeout +3 situation. And this is a nice support day here. The market corrected here. My buy switch is still on. Actually, I think the market pulse said a 20 to 40% recommended investment here. But there's an earnings report, so I have to wait for that. So the earnings report, now this is the Shakeout +3 buy point here. That's the Shakeout below this 72.15. Well, the next day after the earnings release, it trades up here, and that's the buy point right there. Now, the market was under pressure with a 20 to 40%, but my buy switch is on. Well, it rallied out of there nicely. It broke out here again, then stalled. See, it broke out here and stalled. It broke out here and stalled. That by being in early, I could ride out this move. If I bought it here, I'd have to sell it again. And I'm not so sure I'd be up for buying it again. There's a good chance I wouldn't buy it again. Now the third time is a charm. But by buying it early, I'm in it here. Now, for whatever reason, this stock rockets up right here. I don't remember what the news was, but it just surges up here. And it gets to the profit goal. And this is another time to apply the short-term profit extension and just hold on to this guy. It's one of the few times you keep a stock past the profit goal. But when a stock is climbing like this and gets to the profit goal, that's when you do it. And it just keeps on going. It's very easy to manage. And you can use the 10-day line as a guide or even the 21-day line. It's just easy to hold. Now, this stock just kept going, and it sort of got climactic here. And I get nervous about this, and it broke the 10-day line here and triggered a sell rule at the low here for me, and I sold it there. This had a 338% gain in 14 weeks, a monumental compound annual growth rate. It gained almost $68,000 on a $20,000 initial position with no add-on buys, and you would have had some add-on buys. And it was very easy to do. Now, other people probably would have held this stock through this base. It didn't really trigger a big cushion sell rule, and probably it should have been held. Selling it here was a little premature. And if you did hold it through this base, this is when it would get sold. A very sharp decline from the peak and a base breakout failure. Now, selling it here gained more, almost 400% in 21 weeks, with almost $80,000 gained on a 20% initial position. There would have been some add-on buys. Another example that was easy to find and manage was FTAI Aviation. And the big thing with this company was they lease aircraft, but the big thing was maintenance. They came up with a new maintenance program for the engines on 737 aircraft. And they came up with an engine exchange thing so they could swap out the engines that needed overhauling, and airlines could keep their planes flying with less downtime. So now it took a little digging to see that, and you might not even see that the first time you bought the stock, but after a while, if you owned it, you might dig into it and find that. It's on the IBD 50. It was on the 50 for many weeks here. It has a sound tight base. It has a strong prior uptrend. 2 top funds own shares. There's accumulation in here. You can see that they keep it right on the mini chart. You can see it. And there's something new is that aircraft engine swap out maintenance. It has a 10% flat base, the second stage. And then I'm looking at, I zoomed in on this, and it looks like Nvidia. It's got that couplet handle thing in here. So I draw a little trend line and make an early buy point if I want, and buy it here on this day. Now look, there's no volume, but I buy it anyway. I'm not going to wait for the volume. I'm going to buy it because price only is my trigger. Now the stock trades up, and there never was breakout volume. You see, I don't want to wait for breakout volume. The stock trades up, gets to the profit goal. There's absolutely no reason to hold it past that. It's a nice 25% gain in 8 weeks. It's very good money. I take my money and run, and I'm a happy camper. 8 weeks later, the end of October, this stock is setting up again. Now, it was last on the IBD 50 list, the beginning of October, but the fundamental characteristics haven't changed. So it still has top fundamental technical properties. And I'm going to look at the chart, and it's set up in a consolidation here with a trend line early buy point right here. And that's a good time to buy it. And so it's an easy time to buy it too. And lo and behold, there's some volume on this move. And even though it's not a standard base breakout, and look what the relative strength line does. And so it's easy to buy right there. And it climbs nicely. You had several days to buy it. You could even buy it at the standard pivot point here. And it's just a nice setup. There's lots of time to buy this stock. And look what that relative strength line is doing. The market's in a little correction here, and this stock is just going. Oftentimes, the very best stocks break out first. And if we look at this base, we'll see there's the first leg down here. This stock continued to make new highs as the market was correcting. And it didn't start to correct until the second leg down of the market correction. And on the third leg down, this stock barely made a new low. In fact, I think it didn't even make a new low. I thought this is not a double bottom here. So this is a very strong relative strength situation. So we buy the stock here on the weekly chart, and look what this guy does. He comes out of there and he rallies quickly. He doesn't trigger the certainty exception, but he comes out of here and there's 8 of 9 weeks up. And the down week is barely down at all. This is a very strong move. And because we bought it early, I have a 30% profit here, 33% profit when it gets to the standard profit goal. This is another situation where you can apply the short-term profit extension rule or just make a decision to hold the stock. You're just going to hold it. And Bill O'Neill talks about that. And that's one of the sell rules, one of the 14 sell rules, is just decide you're going to hold it for a longer-term gain. You've studied this stock, you know a lot about it, and you just have confidence, and you have enough profit cushion to just do it. Just hold it. And maybe use a wider decline from the peak number, or say I'm going to hold it unless it breaks the 50-day line. Or if you want to be stingy, you can say I'll hold it unless it breaks the 21-day line. Anyway, you hold this stock at the profit goal here, and this is what happens. This is one of these stocks that just turns out to be a real big winner. You don't want to start out with a 5% position in this stock. You want to start out with a 15 or 20% position in this stock, because this puts big money in your portfolio. Even if it's not on a margin account, even if it's in a retirement account, this type of gain here is big money. This is a 270% gain in about 60 weeks. It's capital. If you're in a taxable account, that's long-term capital gains. And on a $20,000 position, that's $43,000 gain. That's huge. And then you figure all the add-ins. This is really big and easy to do. You see the rules are easy to apply. Let's go back and revisit Nvidia. We looked at that. It was the number 2 on the IBD 50 list. It had this nice setup. We looked at the early buy point here. We can make an early buy point at 497. Pretty easy to do. Right here, as we showed before. Now, that's the buy point on the weekly chart. This is a weekly chart here. This is the buy point out of this base. Now, this stock triggered the certainty and exception rule, and you would apply the certainty and exception rule. It's up 20% in 3 weeks or less. It is a bull market. There was a minor correction, so this stock is coming. There's a short correction in a bull market. This is a very powerful stock. It has the best CANSLIM properties of any stock in the database at the time. Certainty and exception, you're going to hold it for 8 weeks. Pretty soon it's up here. You get past the 8 weeks, and you're going to manage it under what's known as the big cushion sell rules. You're going to hold the stock through a base. So you do. Now, this is a pretty easy base to hold through. Nothing untoward happened. And then when the stock breaks out of this base, you can buy a whole new initial position. And it triggered the certainty and exception again. But the way I work, I wouldn't do the certainty and exception 2 times in a row. I would sell it at the profit goal here and be a very happy camper. Now, you can go back and study this. It's entirely possible you'd still own this stock and you would have held it through the base that we just had. But that's not the way I work. So, initial position here where we showed you before at 497, certainty to exception, hold it till we get up in the big cushion rules, hold it through this base. There's a handle by it here, new position. Sell the whole thing when you get up here to the profit goal, the standard profit goal here. And be a happy camper and take the money and run. Now, on this setup, looking where we would have on the first position, we'd have 140% gain in 47 weeks for 87 or about a 90% compound annual growth rate. We'd have a $29,000 gain on the first initial position here, not figuring that out in buy points, and there would be some. Then on the second position, full position here, and I'm just going to assume another $20,000, but it actually should probably be more because by this point, your portfolio would be bigger, hopefully. It would be. But I'm just going to say $20,000, another initial position. The gain now would be $6,400. So the combined gain would be about $35,000. Now we're 6 months into the year, And if you had $100,000 portfolio and you were buying $20,000 positions or a 5-stock portfolio, your portfolio has already gained 35% and you're halfway through the year on just this one stock. If you broke even on everything else you did that year, you had a 35% year. If you have 35% years regularly, you're rich pretty fast. Here is a really giant winner. This is an all-time monster stock. And it's Monster Beverage, which at the time was called Hanson's Natural. And the time of this is a model stock, is from August 2004 to July 2006. This is a stock we study. The first buy on this stock, and this is a model that we've done in the Petaluma IBD Meetup, and you're going to get a link to go where you can study these details. The first buy was in this base here, the green arrow. There were 2 add-on buys right away, and then the breakout failed. The decline from the peak sell rule was triggered, and it had to be sold here. But it formed another base and would be bought again right here in another breakout. And that breakout didn't fail. And it had all these add-on buys made here using the standard add-on buy points that I had in that list before. And went all the way up here. And finally went through a base and then had a late stage base breakout failure here and was sold here. Now this stock in the model was in a margin account. We assumed it was in a margin account with $20,000, and the initial position was purchased with cash, not margin. And the add-on buys were made using margin. This $20,000 initial position gained almost $1 million. Now you think, well, that's not true. It couldn't be, that's impossible. It's possible, it's real, and you can go and study the details. Now, this is the kind of thing, this is the objective of learning how to do growth stock investing. This is the objective. You want to get skilled enough that once in a while, once every 5 or 10 years, something like this comes along, you can make the most of it. You've got enough experience, cooking that Dramagnier souffle, that even when conditions are lousy, you can do a good job and make the most of it. And this is when conditions were pretty good. Now, the market was decent in this time frame, but it wasn't anything super spectacular. But this stock was super spectacular. And it was soda pop. It wasn't high tech, it wasn't semiconductors, it wasn't biotech, it wasn't rocket science. It was soda pop. And Bill O'Neill likes these consumer product companies, so do I. They're easy for me to understand. Okay, so how does this happen? You can, basically, if this is huge, and how does it happen? Well, here's the spreadsheet. This is the first position that got sold. It was bought on August 23rd. We scaled in with the scale in was 3 buys, not like 1 buy that I do now. 50%, 30%, 20%. And this is at the pivot point, or ideal buy point, early buy points are used. 2.5% above, 4.5% above. Then there were 2 add-on buys made. This add-on buy took a loss. The others made money. And this initial position made about $2,400. So you had a little bit of gain. You took that gain and put it back into the next position that was bought on November 10th. And it was scaled in. And then we had all these add-on buys, 11 of them total. And the whole thing was sold on July 10th. And this whole thing had a profit of $995,000 total. So that's the thing. Now, some notes about this. This is a model stock, not a model portfolio. A stock like this would be part of a portfolio of at least 3 other stocks. A single stock should not become more than about 50% of a portfolio, maybe 65% for a short time if that big stock is going into a climax run. Bill O'Neill at one time had all the firm's money in one stock, Amgen. The people that work down there, his son, like to talk about it. It was very, very exciting. Nobody but Bill O'Neill should try to do anything like that. And he only did it once. So 50% is a big thing. When you got half of your portfolio in one stock, that requires a lot of attention. Initial positions were bought using cash only in this example. We scaled in. B1 was 50%, B2 was 30%, and B3 was 20%. And it was B1 right at the ideal 5 point, 2.5% above, 4.5% above, about that. The most amount of margin that was used for this single stock was 50%. Even though margin, the initial position was bought with cash, and margin was used for all those add-on buys. And there were a lot of add-on buys made over the time the stock was low. The stock value grew so much that it had the buying power. We never needed to use more than 50% margin. And that's about, you're buying half with cash and half with the value of the stock in the portfolio and half with the margin loan. And that 50% occurred on November 9th, 2005. So, about a year into owning the stock is when the highest margin use occurred. In summary, the position started in August 2004. We had to buy and sell the first position. It was bought back in November. We sold everything in July 2006, July 10th. Almost 2 years for this stock. Made numerous add-ons, 11 in the second part, 2 in the first. We started with $20,000 in margin account. It earned almost $1 million. Half that gain was long-term. So you get the long-term capital gains benefit now you can't do this in a retirement account because you just don't have enough. You need the ability to use margin to do this kind of thing. And so that's a good reason to start. Even if you have most of your money in retirement accounts, you want to get a little margin account going and learn how to do it. Because, you can see if you have a $20,000 margin account, it could get big fast. So margin is very powerful. The 2 original positions were made without any margin. That's a cautious way to use margin. Use cash to buy the initial positions and only use margin for add-on buys. And you only make add-on buys if the position is up and working. So it's a good way to start out to use margin. And 70% of the profits that were made in this stock were made on the add-on buys. So add-on buys are very important to learn how to do. So there's a recorded presentation for Hanson Natural with all the details, the spreadsheet, the slides, and a video presentation. The slides and the spreadsheet are in Google Docs. This was done by one of the members of the Petaluma IBD Meetup, Michael Nestler, and he did a really excellent job on this. And it's at this link here. This model was also a Bill O'Neill model in his book on page 104. It's interesting to note that he bought this stock here out of the second base. He didn't buy it here. The model that Michael Nestler did, and I agreed with him. If I modeled it, I would have bought it here. And then Bill O'Neill sold it here. He called this a climax top. And he is better at seeing this stuff than I am. I didn't see a climax top here. And you can't draw an upper trend line that spans bases. So there's no upper trend line here. So Michael Nestler didn't see this climax top here either. He sold it at this base breakout. It's Mox Nix. It's about one and the same. So stocks like Hanson Natural, and I've got the wrong symbol here, or Monster Beverage can be life-changing. And Bill O'Neill talks about that in the Investors Business Daily newspaper in 2010 and 2012. Bill O'Neill put model stocks in every week for about, 14 months or something like that, maybe 18 months. And he annotated them with lots of terrifically good notes. And one of the ones he put in here was Simmons Precision. I put a screenshot of the whole thing, and I zoom in a little bit here. And let's zoom in a little bit more here. You can try to read these notes. If you don't have these, try to get them from somebody. If you're connected with people, somebody might have them, they can share them with you. But this is the note he wrote in here that's important. It says, in the next 20 years, there'll be 200 stocks that will go up 5 times or more. Getting just 2 or 3 of these could change your whole life. That's the type of situation that Monster Beverage is. Simmons Precision was like that too. Now he says, you could do this. Learn to read charts well and do it each week. Learn the individual stock buy and sell rules and follow them. Learn the general market buy and sell rules and don't argue with the general market. Don't be lazy. Believe in yourself and the rules. Develop a few motivated friends who are seriously studying CANSLIM rules and are looking for the best stocks. Who cares who comes up with a big winner as long as you get the idea too? Okay, now, if you guys are interested in anything I have to offer, I've started IBD is changing. They're not sponsoring meetups anymore. I've been the co-organizer of the Petaluma IBD Meetup for a while. I'm not sure how that's going to shake out, whether I'll still have a meetup group or not. It's still a work in progress. I've started a Google group called Growth Stock Investors One Style. You can find that and join it if you want. You can just join. You don't need any permission. And then I can be in touch with you, or just send me an email. There's my email address. Send me an email. Don't expect an immediate reply because I get an awful lot of emails, and sometimes I'm a little slow about it. Anyway, this concludes my contribution to the TraderLion 2025 conference. Thank you for your courteous attention. My name is Lee Tanner. I'm an amateur volunteer, not a professional, and I'm not recommending anything except learning this. And happy and profitable investing to you all.
Lee, thank you so much. That was really fantastic. Thank you for running through that, especially the examples at the end. I think bringing it all together. I do have a few questions. First, I think from the previous video we did and what you reemphasized today, that I think should be a key takeaway for everybody is I think I asked you what in the previous video, what mistake did you recently make that you've worked to build rules around, and you talked about, again, that not being invested enough during a strong trend was the key thing that you focused on more recently to improve on, and you reemphasized that today. And I think that's so true, because once you're caught off sides in an uptrend, you feel like you're underinvested, there's a rush, and you might find, it just causes a cascade of problems down the road that maybe lead to more losses. One thing I did ask you about sizing after a correction, is it your typical sizing that you do, or do you do any test trades and then scale up if those trades end up working out?
I don't do test trades. I just go for it. And I've learned that by post-analysis. It works better for me. But people with experience, they have to figure out what works for them. For me, it just works to go for it. So I size my portfolio based upon, I size my positions based upon the size of my portfolio. And I typically start out with a 7. I have a pretty big portfolio. So I start out with a 7 stock portfolio. So whatever the portfolio size is, if it's $1 million, I just divide by 7. And that includes my intention to use margin. Mm-hmm. So, it's my buying power. So if I have $1 million buying power, I'm going to divide by 7. and then I'm going to buy that as I start out. And I'm just going to, so if I showed this example here, the first stock I buy, I'm going to buy 1/7 of the intended buying power, and I'm just going to go for it. I'm going to be very careful and watch to monitor for sell rules. I do not want to miss a sell rule. So I don't want to be looking away and suddenly look up and stock's down 10% or something. In fact, if I can't be really diligent about watching, I'll put a broker stop in. I use broker stops. And I don't use a minus 7% stop because I don't like just shaking out. I use a minus 9% stop. That's what would have trigger intraday. And then I use a 7% limit on a closing price basis. So I go full position. I don't scale in, and I don't do trial balloons too much.
And if the stock makes progress from the breakout or your buy point, Shakeout +3, and say you're up 10%, it hasn't yet hit the profit goal or anything like that, are you adjusting your stop loss at all to break even, or are you keeping it at that original 7% or where you placed it?
This is a really good question, and I recently did a presentation on sell rules, which is on the Petaluma IBD Meetup website, or it's on the file hosting website. As the stock starts to move up from the buy point, I leave the sell point, the sell trigger at the capital protection sell rule minus 7% until it gets up about 10%. And once it's up about 10%, then I start to follow the stock up with a trailing stop. And I use a decline, and I call that a decline from the peak, or the trailing stop is about 14.5% from the recent high. Mm-hmm. So I don't want to follow the stock up with a 7% stop. I want to let it get some cushion, some room. Bill O'Neill says room to fluctuate normally. Mm-hmm. And then once it's up about 10% or so, I start following it up with a trailing stop. And that's what I call the decline from the peak sell trigger.
And one more question on the sell rules. If a stock triggers a profit goal exception, it's shown superior strength, and you're using the 10-day moving average as your sell signal, is it a close and then a close below that low of that first close that triggers the final sell as it breaks below that 10-day moving average?
Yes, exactly. And that's what that's Dr. Chris Ketcher sell rule. That's his way of triggering it. And that's the way I do it. So if the 10-day line is what I use, it has to close below the 10-day line, and then the low of that day becomes a sell trigger, and I put a broker stop in for that. I'll look at the low of that day, and I'll put a broker stop for maybe 10 cents below that low.
Excellent. And for big cushion sell rules, if you've got a sizable gain, it's enough that you want to hold through another base. At that point, are you switching from looking at a daily chart to a weekly chart to monitor the stock? What are some tips that you give people to try to hold big winners longer to really get the most out of those trends?
Well, the big cushion sell rules are very specific. And yes, it really does turn to a weekly basis. I still look at the daily charts, but the trigger is weekly. So if I own a stock that's up more than 50% from the initial buy point, I have in my rules that I have the option of applying the big cushion sell rules. And the first, and what that is I'm planning to hold a stock through the base. What I'm looking for is a significant change in character of the stock from strong to weak. Now, all good stocks, strong stocks go through normal bases, but I'm looking for a change in character. And the first thing is a close below the 10-week line for the first week that it closes below the 10-week line on volume that's plus 40% or more. Mm-hmm. Bill O'Neill was very specific about that rule in some of the workshops I've attended. So, and it's the first week, not the third or second week. You're looking at the first week that the stock starts correcting. If it closes the 10-week line the first week, below, and not just a smidgen below, like 2 or 3%, 4% below on really big volume, that's a significant sell rule. That's when you would sell that. Now, if it closes below the 10-week line and goes and later has big volume, you don't sell it on that. Another sell rule for that in a big cushion rule is if it's just persistently weak for a long time. It just muddles along below the 10-week line for a long time. And then another big cushion sell rule is if it goes into a climax run, of course, you're going to sell it. That's the objective of big cushion sell rules. You want to hold stock that's eventually going to go into a climax run, because then you can make really big money.
Excellent. And I really love the details that you went through with like the hood example of this recent correction. Just some things that you point out with regards to helping spot those names that could have the potential if the trend actually gets going. Looking at the relative strength line, not making a new high before price. The stock itself not falling much before that relative low that the market did. The relative strength line making a higher low as the market makes a lower low, not falling as much as the market. I think all these just recommend for everybody to rewatch that section if you missed that and take special note of those details. Is there anything else, Lee, that you really like to look for during a correction that makes the leader stand out, the names that you want to try first if your buy signal turns on? What really makes you focus on a stock after a correction, or in the latter third of a correction as you see it?
The one key thing is, is it on or was it recently on the IBD 50 list? Mm-hmm. That IBD 50 list has a sensitivity for accumulation that I can't duplicate, and I don't know how they do it in there. They have more data they use than Market Surge has for me to use. So I look at that. Is it on or was it recently on? So the market's correcting, and those are the stocks I look for. I look at the chart patterns, but those are the stocks I focus on. The ones that were recently on that had good fundamental characteristics. I also look for the big winners. If there's a big market correction like we recently had, what stocks were doing really well before the correction? And oftentimes when the market starts out of a correction, those will be the stocks that have the biggest gains coming out in the correction. So that's the way I approach that. And then I just, and for example, I looked at Netflix. Well, it just had a remarkable relative strength considering the depth of the correction. So relative strength is another factor that's very important. And so, on Market Surge, they have that blue dot. And if that indicates the relative strength is making a new high before the stock is, that's a key factor. But just look at the relative strength rating. I have a screen I can run, but the Investors Business Daily screen called Sector Leaders, or Stock Spotlight, they put stocks that have strong relative strength get on that screen. And so and the other thing we have at our disposal nowadays too is just the ETFs. Sometimes it's occurred in this last time in my actual portfolio. The first thing I bought was an ETF, mm-hmm. And I bought the triple Q. But you don't need to be wild and buy the triple Q. Buy the double Q or just the Q. If there's no bases and you think the market's going to bounce, just buy the Q. And if it doesn't work, keep a tight leash on it and get rid of it. And if you buy you might even buy a 20% position in the Q or double Q or triple Q if you're really optimistic like I am. And then if you need the cash, if you go on to buy stocks, you can scale out of the index fund. Now, the advantage of buying stocks rather than the index fund is that if the market does correct some more, it's not infrequent that a stock will survive the second or third correction, whereas the index funds won't, obviously, particularly if it's a double or triple, it's going to go down a lot. Mm-hmm. Whereas if you bought a really good stock, it might have unusual relative strength and not correct as much if the general market corrects. So I prefer to get my money into stocks if I can, but this particular rally, I still have a big position in the triple Q, and the T triple Q actually, and it's been very, very good.
Excellent. And I really enjoyed the Hansen's Monster Energy example. Looking back on that case study, what were kind of the CANSLIM characteristics that stood out that would get it on your radar in the first place? Did it have really strong earnings and revenue growth as well, in addition to just amazing price action? I mean, it pushed so far off those lows even before the bases that you showed. Yeah.
Yes, it did. It had very favorable CANSLIM characteristics when it broke out of the base. And in the presentation that you can get on that link that I gave in the presentation, it shows that stuff.
Mm-hmm.
It shows it. The slideshow has that information in it. What the properties of the stock were at the time. I think it was on the IBD 100 list when it broke out. So at the time, if I recall correctly. So it was a notable stock. It was pretty well known, and it wasn't something you'd overlook.
Gotcha. Lee, this has been really great. It's so cool to see an application of the O'Neill system, to current markets and to have you explain it. So appreciate your time immensely. Any last bits of wisdom that you'd like to pass on to everybody watching, or any key takeaways that you want them to have, especially from this presentation?
The one piece of wisdom that I share with people in my meetup and my email groups is, if you want, there's so many different ways to invest. And there's so many ways to learn it now with the internet, my goodness. If you want to do any particular way, pick it and then stick with it. So in the O'Neill method, I started working with a lot of people. They start out with this. The next thing you know, they're swing trading or they're doing something else. They get distracted. So if you'd like to do the O'Neill method or any other particular method, pick that method and then really learn it and stick with it, and not try to mix and match it with another method of investing. And it's hard not to do that, because there's so much information out there. Even Investors Business Daily now, they've got swing trading and they have their morning talk group, and it's easy to get distracted. The O'Neill method is really pretty straightforward if you stick with it and don't try to mix swing trading into it. And swing trading is actually kind of alluring, because most of us aren't very patient. We don't want to hold that. We don't want to hold that stock while it goes from the pivot point to the plus 25%. We get impatient along the way. But if you want to do this, try to stick with it and give it a chance. And then if you don't like it, try something else.
Excellent. Well, Lee, thank you again so much for your time. Really appreciate it. To everybody watching, I hope you guys enjoyed immensely. Leave a like down below. Subscribe if you're new to the channel if you did. And we'll be right back. Stay tuned.